Yeah, just to alert people, we've got the 0.5%, the full expected, and you know that contrasts with what we saw in the United States, the Fed only going 0.25%. So clearly they are still worried about what inflation is doing to the economy.
They are. Let's see if we can put those numbers rapidly onto a graphic that we prepared earlier. So you can see from this graphic, GBNews viewers, radio listeners will have to bear with me, that interest rates were well below 1% during the years before the COVID lockdown. During lockdown itself, rates went all the way down to just 0.25% at emergency levels. Since that lockdown ended, we've seen successive rate rises, 10 successive rate rises now to 4%. That 0.5 percentage point increase today, as you can see, that takes interest rates to a 14-year high, the highest they've been pretty much since the global financial crisis in 2008-9. This will slow down the economy a little bit more. The Bank of England, the economists in the Bank of England, the 9-strong Monetary Policy Committee, it will be interesting to see the breakdown of those votes. There may well be some MPC members who didn't want a rate rise today, or only wanted a 0.25% rate rise, because, economics is not an exact science. Reasonable, intelligent people can have different points of view. You can easily say, I think there's going to be a lot more inflation. You could say, I think actually inflation is now going to quite quickly come under control. I tend to be in the latter camp, and that's why I think that after today's rate rise to 4%, there'll be one more rate rise to come of 0.25%. You say that's what the Federal Reserve did earlier this week, the most important central bank in the world there in the US. But that's because US inflation now is down at 6 or 7%, much, much lower than it is here in the UK, where we are still, at least on the December numbers, Mark, in double digits.
And we reflect on what Andrew Bailey has said before, of course, the bank believing that the recession will be shallower, although maybe slightly longer. And this is the nuanced judgment they've got to make alongside all those other forecasts, including that IMF one, about how hard you put that foot on the brake.
It's all about credibility, Mark. Central banking is about hard-won credibility that's easy to lose. I personally think, and I say this with regret, I'm a big supporter of independent central banking. I have been all my professional career as an economist, but I do think the Bank of England lost credibility last year. It was far too complacent about inflation. It kept saying, oh, this inflation is going to be transitory, and all the rest of it, where commentators like me were saying, no, it's not, it's going to be very serious. So the bank was too slow to start raising interest rates, in my view. That's why it's had to raise them more than it otherwise would have, to convince financial markets, to convince those investors who lend the UK government money buying what we call gilts or government IOUs or bonds. They have to be convinced that the Bank of England is serious about getting on top of inflation, hammering those price rises out of the system. Because if they don't think the Bank of England is serious, they'll charge the British government a lot more money in order to lend, in order to give money to the British government to pay for all the public services that we need. So it is a credibility game here, and by going for a 50 basis point, a half percentage point rise, in my view today, the bank is asserting its credibility. It could have followed the Fed and gone for a quarter point. It's gone for a half point, the more painful option, as if to say, no, we are really very serious, financial markets, about getting rid of this inflation so you can lend us money more cheaply, so that's better value for British consumers. Yeah,
let's talk about the pain. Some 1.6 million people estimated to be on mortgages at the moment. Variable rates, average extra on a tracker, about 50 quid a month, already facing other raised costs, and of course that's out of taxed income. So I guess a lot of families will be trying to crunch the numbers. And it's interesting, we got Which, the consumer group, pointing out that about 2.3 million households have missed or defaulted on at least one payment on a mortgage, rent, loan or credit card in this month's January or last month January alone.
Look, I would say this: if you are coming off a fixed rate deal, and the vast majority of mortgages are on fixed rate deals, about 8.5 million, about 2.5 million on variable rates, as you say, Mark. If you are coming to the end of a fixed rate deal, then I would wait before going for another fix. I would wait until interest rates are starting to come down. The next move, I would wager a fair amount of my own personal money that the next move in interest rates will still be up. You don't want to fix your mortgage when there's still more rate rises to come. You want to fix your mortgage when there's at least one rate cut in the can, with more to come because inflation's falling. I do believe, I'm not qualified to give financial advice, at least not on television. I do believe, though, as a matter of opinion, that rates will be coming down towards the end of the year.
Right.
And there will be a mood, a consensus that we're on top of inflation. So don't fix your mortgage now. That's my surmise, my advice, but it's not professional financial advice.
No, absolutely, because the FCA won't like that. But let's actually just address some of the figures that we got coming out. As you were describing about the committee itself, we've now been told 7 members voted to increase this 0.5%, 2 voting to keep it unchanged. And in terms of its assessment of what's going to happen, the bank predicting a recession 5 consecutive quarters to fall by 0.5% this year. Now, that's, I think, a slightly shorter and shallower drop than was previously being talked about.
Well, it's slightly less of a dip than the IMF are predicting. They're predicting 0.6%. But I haven't seen the report, Mark. I've been looking down a camera lens to you, talking to GBNews viewers and listeners since that report came out. But it seems to me that the length of recession they're predicting, with all due respect, is pretty much the same as the length of recession they were predicting before. I still think the Bank of England, having been slow off the mark to spot inflation, is now over-egging it. They're now overdoing, in my view, the economic gloom. I think the British economy will recover a lot quicker than that, despite these interest rate rises. So I personally think that the Monetary Policy Committee and the Governor, with all due professional respect to them, on that basis are wrong. But of course this is economics, nobody really knows anything. That's why they call it the dismal science.
Yeah, and it keeps us in business as well. Liam at the bank for the moment, thank you for that. Back to you shortly, but let's just actually reiterate what the bank is saying about the way ahead. It's now saying that the recession that it's seeing, what it calls the peak to trough GDP or growth drop, will be 1% compared to its previous forecast of a 3% drop. So it's not going to be quite as bad as they say. But as you can see there, 4% is the base rate now, up 0.5%.